Lately, the financial media has been covering very closely and with a great deal of intensity the, quote, yield curve inversion as an indication of a U.S. recession. Well, where they get that from is indeed there has been a yield curve inversion in the sense that the longer-term riskless maturity bonds put out by the U.S. government, there's been a great surge of buying. Prices have been rising, which means the market yield to the buyer declines because the return has not changed, but you're paying more for the same return. So the yield to the buyer has declined. Now, basically what we're talking about is that usually is a typical reaction to preparing a portfolio for a recession. Basically, what typically would happen is if indeed investors in general saw a recession coming, they would seek to pull their money from the equity markets that would be affected by a recession. So you would expect equity prices to fall and bond prices to rise. Also, the other part of the mechanism of causing a great deal of demand for long-term treasuries would be if investors would be seeing a deflationary event occurring. And when prices in goods markets fall and owning a security that pays the same amount with very little risk, basically you pay more for that contract, the yield to the buyer declines. So you have a situation of scrambling out of equity markets into longer-term debt markets. Well, does that hold today? Well, we're not seeing the stock market being priced anyway for a recession. And basically, where in the world is this deflation expectation coming from, where it would be so intense that you're pulling out of other types of assets and buying long-term treasuries? It just doesn't hold. So the question becomes, where indeed is the demand for long-term treasuries coming from? Well, the most likely answer is from Europe or Japan or any of the countries where their central banks are running aggressively stimulative policy of not only just low interest rates, but negative interest rates. Now, put yourself in the position of being an investment manager in Europe. You're managing, for example, a portfolio of pension assets for a company to pay its pension obligations. Well, you do need yield because they assumed that these pensions would earn 4, 5, or 6% in order to make their contractual payouts. But the yields in the markets are negative, so you're not going to be able to achieve your goal. In fact, you start heading toward a bankruptcy. So the question becomes, what do you do? You're an investment manager, professional investment manager, managing the money for an insurance company, for a pension fund, or an endowment fund, and your market yields start going negative in your portfolio. Well, the easiest thing to do today, because the legal environment now allows it, is to sell your euro-denominated bonds, take the euro and go into the foreign exchange market and buy dollars, causing the dollar price to rise relative to the euro. And with those dollars now buy U.S. treasuries, which pushes up the price of the U.S. treasuries and brings the yields down. So basically, this is the most likely cause of this yield curve inversion. The reason it's happening now, and it's getting a lot of attention because of the surprise, because it did not happen in the past in this way, and that is because most of the countries of the world had capital outflow restrictions, and the capital outflow restrictions would not have allowed private investment managers to move out of their currency into a foreign currency, into foreign investments. It was really only the last 20 years that this is a new regulatory development abroad, not in the U.S., but the foreign countries didn't want their capital to be deployed outside their own country. So they did not allow capital, generally did not allow capital to flee. So basically, those restrictions got eliminated over the last 20 years or so. This is the first time foreign capital surging into the U.S. really is making a difference to our capital markets. And it's a defensive operation on their part of a portfolio manager not achieving any yield so that the obligations will not be met. So basically, it is overblown in the press. This yield curve inversion is an indication of recession.